Hey folks, Jed Bratt here with your month of June 2020 San Diego County real estate market update. In this video, we are going to take a look at, as we always do, the San Diego County recent numbers as far as active and new listings go. We're going to look at pending sales, sold listings, as well as the median sales price and days on market, typical numbers. We're also going to look at recent interest rate numbers. We're going to take a look at how those recent record-breaking interest rates are actually affecting the current market and the supply and demand, as well as an update on a new program for one of the major wholesale lenders in the country. We're going to look at some unemployment claim numbers, forbearance numbers, inventory topics. We're going to talk a little bit about things that are impacting inventory and maybe holding that jump in inventory that we're kind of hoping for back. And we're going to talk about my final thoughts as far as where we're currently at in the San Diego County real estate market and what it might mean for you as either a buyer or a seller. So let's go ahead and dive in. If you haven't already, be sure to subscribe. And if you enjoy this video, please like it. It really helps me out. And if you know anybody else who'd find value in this sort of content, be sure to share this with them as well. As always, thanks for watching, and let's go ahead and dive in. All right, so we're starting off taking a look at active listings in San Diego County. As we can see in the month of May, at the end of the month, we had 5,422 active listings. That's down 29.3%, nearly 30% year over year. Same thing with new listings, down 22% year over year. So we have a major shortfall on active and new listings. Pending sales were down nearly 11%, and sold listings are down 44.8%. If we look at the average days on the market, active market time, down nearly 20%. As you can see, pending sales are not, I mean, they're only down 10%, but the inventory is down 30%. So there's more properties, there's only 10% fewer properties going into escrow right now than were last year at the same time, even though we have 30% less inventory. So if that doesn't tell you that it's a hot market and more buyers are competing over less inventory, you know, that's exactly what the story is telling you, okay? If we look at active market time though, like I said, 17.2% down year over year. So things are going off the market fast. Months of inventory actual down 25.9%. This is the absorption rate, so the percentage of properties that are basically just getting swept off the market as quickly as they come on. So we have about a 2-month supply. And I would really argue that the majority of the homes that the average home buyer is looking at, there's a much smaller supply than that. This is a bit misleading because there are some properties that are still in the market that are overpriced or just unrealistic. Maybe they need a lot of work or something. But the average home that's being listed right now, that's priced well, it fits the majority of the criteria of the majority of home buyers out there, and it's financeable. I mean, they're flying off the shelves. Now, of course, if we look at different price ranges, if we go up above the median price into not so much first-time home buyers, then of course that's also going to carry a lot of that inventory there. But really, as far as like the first-time home buyers market, median price and below, we are really seeing a very fast sales rate. And the majority of these homes are having multiple counteroffers on them, okay? Or multiple offers, which typically leads to a multiple counteroffer situation. The sales price, the median sales price in San Diego County is up 1.7% year over year. So we're at $585,000. Not a whole lot of movement there. But the movement we've been seeing is probably likely to continue driving that up. And in fact, like the lower sector of the market is definitely, the data is pointing that that's going up. And even though the median sales price seems a bit unchanged, it might be the top sector that's really suffering a bit more, relatively speaking, because the buyers that are really gaining a huge benefit from these low interest rates are typically going to be first-time home buyers. So that little difference in payment, or actually a big difference in payment with these crazy new low rates we have, is going to make a much more substantial difference in their budget and buying ability than somebody who, for example, might have $500,000 in the bank or is putting down a significant down payment on a property near $1 million. Let's look at interest rates. So the 30-year fixed rate on a mortgage as of June 25th is at 3.13% for a 30-year fixed across the United States. So this is across a lot of different types of loans, but folks, this is a record low as far as we've been keeping track of mortgage interest rates. And I feel kind of silly because every single time we're talking about rates, there was a short period of time we were saying, okay, rates are on their way up. But in general, the main narrative has been, oh, interest rates are low, you got to refinance or you got to buy now. And I mean, this is the lowest interest rate we've ever seen. We've talked about the possibility of crazy low rates in the past. And Bruce Norris, who we follow quite often, we mentioned him in a lot of videos. He brought up the possibility of 2% interest rates, I want to say 2 years ago. And what we actually have, and I'll talk about it in a second, are definitely some programs where buyers are getting in the 2% for 30-year fixed rate mortgages, which is just, which is incredible. Because let's take a look at this. In the beginning of the year, in January 2020, the median sales price across San Diego County was $587,000. Since today it's $585,000, let's just call it the same, okay? $585,000. The average rate in the United States was, for the 30-year fixed, where am I? January, let's go back to the very beginning of January. We were at 3.72% 30-year average fixed rate, 3.72%. A principal and interest payment on a $585,000 loan, just principal and interest, would be $2,700. In June of 2020, our median sales price is $585,000. Our average rate is 3.13%. And as I mentioned, there's many loan programs out there that are allowing buyers to get much lower than that. But 3.13%. That brings a P&I payment, principal and interest payment, to $2,507. That's $192 less per month for the same purchase price, same loan amount. That's 7% more affordable. 7%. So in theory, that change alone could up the ceiling, per se, to bring us back to the same affordability level as we were in January. We could increase in median sales price, or in the average price that buyers are paying for homes, by 7%. And just to get back to the same affordability level that we were at in January. I'm not saying that's going to happen that fast, but you can see why so many buyers are out there. And in many of these properties, we're seeing not necessarily 3, 4, 5, but many times 10, 15, 20 offers on properties. And I'm talking in a matter of days. It's really crazy. So 7% more affordable, $190, almost $200 less per month for the same home. And that's only talking about a $580,000 loan. I mean, of course, we're going off a $585,000 loan. So if you're using FHA or conventional, you're going to be putting a little money down. If it's VA, it's probably going to be 100% financing. But nonetheless, you can see how that's a major incentive. And when buyers are looking at that, let's say they were shopping in January, they took a break for COVID, and they're coming back on the market. Maybe they're looking at their previous budget. Maybe their budget was, $3,000 a month, and now they're looking at the homes that are available, and they're saying, okay, they're going for more, or there's more competition, so I need to be much more aggressive. But that's totally fine. I'm going to offer $30,000, $40,000 more than I would have before, because I'm still going to end up with the same payment that I was anticipating in January. So that's the kind of mindset that a lot of winning buyers are going to have right now. And it's a very, very competitive market out there. And to add on to that, like I mentioned before, one of the main lenders out there, the main wholesale lenders. So these are kind of the warehouse lenders, the lenders to brokers. Okay, so if a broker is shopping for a loan for you, one of the lenders they're going to be looking at is this major wholesale lender in the United States. And they just brought out a program for VA loans as low as 2.25%, 2.25 to 2.375%, 30-year fixed, and in many cases with little to no points, no discount points to get that rate. That is just, that is 2.25%. I'm not saying, don't get me wrong, like there are going to be other finance costs, but in large part, that's a no cost, that's the no points loan that I'm talking about. There are a bit more strict guidelines as far as the requirements for the credit and the debt to income ratio, but nonetheless, that is an incredibly crazy program. So if you compare that now with a buyer that maybe in January was looking at a 3% loan, I mean, now we have a 3 or 3.25% loan. I mean, now we even have a more drastic decrease in payment for the same loan amount, which again just incentivizes buyers to be able to offer more and be much more aggressive, which is only contributing to this crazy competitive market we're in right now. It's crazy. Buyer demand has remained at or exceeding the levels we were at pre-COVID, whereas we're down 30 to 40% on inventory, which is just, it's a tough combination. And as far as interest rates go, I mean, the 10-year Treasury, which pretty much the 30-year rate tends to track, is still, it just hit its 6-week low again. So it's holding steady. It's holding very low. Based on what's going on globally, I don't expect a whole lot of movement necessarily unless there's some crazy changes, but I wouldn't expect rates to move upwards very much over the next year or 2 years. As far as unemployment claims, initial claims was 1.48 million. The 4-week moving average 1.62. We're still seeing, I mean, in excess of a million weekly claims, which is pretty substantial. It's slowed down significantly. We obviously had this major spike right when the economy shut down, but it is slowing. But if we were to put this in context and really look back to the Great Recession and the Great Depression, we are still at very significant highs for jobless claims. So we'll see how that plays out. Let's look at some other articles. So half of U.S. homeowners are struggling with mortgage payments due to COVID-19, considering selling their home. I don't know that I necessarily take this article at face value, but this poll of 2,000 homeowners found that 52% are constantly concerned about making their mortgage payments on time. 47% of the poll say they're considering selling their home because they can't afford their mortgage anymore. There's a lot of forbearance programs out there that are very helpful. And in fact, if you're in this situation, and I hope you're not, but if you're in this situation where you are struggling to make your payments, knowyouroptions.com is a great resource for you. And it's for Fannie Mae and Freddie Mac held mortgages. I recommend you checking that out. They have a lot of great options there for you. But there's a lot of programs for forbearance and for people that are having trouble making their payments. So despite that, there's a lot of struggling still going on. Survey, 30% of Americans have rated retirement savings during coronavirus lockdown. People are being much more conservative on their spending, and they're having to dig into some of the reserve accounts. Coronavirus mortgage bailouts suddenly swell as homeowners face new struggles. As of Tuesday, 4.68 million homeowners were in forbearance plans, allowing them to delay their mortgage payments for at least 3 months. This represents 8.8% of all mortgages, up from 8.7% last week. That's a huge number of mortgages, a huge percentage of mortgages, but what we have to keep in mind is they're making this very easy. The bar is very low to qualify for forbearance. So if you call into your lender and you say, I am having trouble, I'm suffering a financial difficulty due to COVID-19, that's essentially all you have to say for them to enter into a forbearance agreement with you. Now, it doesn't mean that that's the right choice. It doesn't mean that necessarily at the end of the day, it's going to be a good financial decision. However, we are seeing a lot of homeowners taking advantage of this. I do know of some people that I don't believe are necessarily in the dire straits financially, but they are taking advantage of this because the way they look at it is the options that Fannie Mae lays out are that at the end of the forbearance period, they're going to have the option to either make a lump sum payment if they want and can afford it, to make short-term repayment plans, or just an overall deferral. So they can actually tack that on to the end of their loan and pay it off whenever they refinance or sell the house, which is seemingly, it's an attractive option. I mean, if you're making a $3,000 a month mortgage payment and you consider that you're going to have $36,000 more in your account at the end of the year, great. But you also have to think of the other ramifications of that. For example, they say that maybe that's not going to hit your credit directly, but is a lender going to look at somebody who possibly had the option of making a payment, but because one of these programs was available, they decided to take this option and say, I'm just not going to make my payment because I have the option not to. Are they going to take a look at that type of borrower if they're applying for another loan and look at them in the same light as somebody else who could have taken that same benefit, but decided to continue making the payments as they agreed to? My gut feeling is that an underwriter might favor the second one first, but I don't know if that's going to come into play or not. Some other things to keep in mind regarding inventory. So, number of homes taken off the market doubles to coronavirus. Now, this is back in April of 2020, but we're not seeing a spike in the number of homes coming back on the market. And what this indicated was that there was a 148% year-over-year increase in homes being delisted, taken off the market in March. And if we look at this seasonally, I mean, you can see every year we should be coming up on inventory. We should be building up inventory until June, July, August. Up until June, July, August. Every single year we have seasonal cycles for market inventory. And we are just not seeing that this year. In fact, we're flattening out. We've kind of plateaued, and we've actually gone down from April to May for active listings. And if this is correct, if there's really homeowners that were holding off on putting their home on the market, or actually had their home on the market and they're delisting it and planning on putting it back again later, you might think that we would have some sort of spike in new listings coming up. But here is part of the challenge to that is when we have these low interest rates like this, depending on how long they last, I mean, if buyers get in their mind, homeowners and buyers alike get in their mind that these are here to stay and they're not going anywhere for years and years and years, then we might see a bit of a change. But as it sits right now, what you have to think of is if a homeowner is refinancing their place, or if they're looking at buying another place, or they just refinanced their place and they got one of these crazy low interest rates, 2.75, 3%, or in some cases 2.25%, are they going to be as hasty to sell and move to another place if they are of the opinion that they might not be able to get that same desirable interest rate? So if you go from like let's just use a crazy example. You go from a 2.25% interest rate to another property that's a move-up property, so more expensive, and it's a higher interest rate. Let's say you're still getting a killer rate of 2.75%. Is that going to be worth it for you to have that increase in payment? Not only just because of the increase in the purchase price and the loan balance, but also because of the increase in the interest rate. And that's what I think some home buyers or move-up sellers are sort of thinking, or if they're not right now, that might be something that's kind of subconsciously inhibiting people from moving forward on that. And I don't know how long that's going to last, because the more I had a 2.75 back when 2.75s were unheard of, and I thought a little bit extra before selling that or refinancing or moving to another property, because I'm like, when am I ever going to get this 2.75 again? And since rates had gone up into the threes, at some point they almost touched 4, and I was like, I'm never going to get this rate again. So it has to be something that you have to think about, and it might be playing a part in what is going on in buyers' mind, in sellers' minds and buyers' minds. Also, as far as inventory goes, the military, which is big in San Diego County, we always have a percentage of our inventory that is due to military transfers. So PCSs, or permanent change of station. And that's, of course, also in play when we have buyers coming out here from different duty stations, but also for sellers that are selling here and they're moving to other duty stations. So it's a give and a take. We gain some inventory, but we also lose some inventory because we have equal and opposite demand usually coming in. But nonetheless, we haven't had any PCS transfers since the beginning of this COVID thing. In fact, the military was originally putting this off. They were pushing off PCS transfers until it was estimated July, but they just announced that they are not even going to necessarily open up PCS transfers for the foreseeable future until basic criteria is met as per the national guidelines for reopening. So being that California is considered a red state and movement in and out of it is considered an unnecessary thing unless under very certain circumstances of the military, this is putting a complete halt on any normal would-be military move sales, and that that in and of itself is an impact to the current supply in the market. So whenever that opens back up again, of course, we're going to see a few more properties come on the market strictly due to military members that are PCSing. They're moving elsewhere. But of course, then again, we're also going to have the inverse demand of buyers coming in. But another thing that's kind of halting inventory, because we really want flow. It's kind of like money. In order for the market to be healthy and move, we need movement. So even though we have maybe 100 buyers coming in and 100 sellers going out, we still want that movement because it's the lifeblood of our system. And if we don't have that, things start to kind of cramp up as we're seeing right now, and things get much more difficult for the buyers that are out there looking to buy homes. Mortgage applications, and this is kind of going to my previous point, a lot of the demand in the mortgage market right now is refinances. The refinance share of mortgage activity increased to 63.2% of total applications from 61.3%. Adjustable rate mortgages shares are only 2.8%. So nobody's getting an adjustable rate mortgage. Everybody's grabbing these crazy low fixed rate 30-year and 15-year fixed rate mortgages. And again, if you have a super low rate, it's kind of hard to ditch that if you don't think you're going to get that same rate again on your next purchase. So, yeah, folks, look, I mean, the current trend right now is majorly decreasing inventory. We aren't recovering the inventory as we should be this time of year. We've already plateaued. I'm hoping that it picks up again because we really should be building up until summer. Maybe we're going to have maybe we're just lagging and we're going to see this catch up a little bit. It's not going to be like we were last year. It's just not. With these interest rates, the buyer demand is in excess of what we've seen like forever. I mean, this is the most affordable interest rates we've ever had. So buyers are entirely incentivized to be buying now as opposed to renting. The question is going to be, are buyers going to get fed up and tired with the competition, or maybe just not be able to hold out until they can actually get a property that they can afford despite these low interest rates because of the competition? And are they going to settle for signing a long-term lease again? Are they going to stick to month, or are they possibly is this going to enhance the migration trend outside of California to another state where they have more of a higher chance of actually getting into a property that's affordable for them? They can still grab those low interest rates, and they're not going to be so stretched financially as they are in California. So there's a lot of considerations. There's a lot of unknowns. Despite what anybody says they know about the market, it is a crazy place. It's a bit of a challenge. So if you're a home buyer right now, look at your numbers. I would say be very clear as to your bottom line, because if you really want a place, you better be going in strong. And I hate to say this, because if everybody's going in strong, then I mean, it's just, it's a brutal market out there. But you have to be a strong buyer to be in this market right now. And if you're a seller, and if you're really thinking about selling, if you're moving, or if you were thinking about selling prior to the pandemic and you're holding off, I can tell you right now, folks, this is the time to sell. I mean, this is the time to sell, okay? And we can help you get top dollar if that's what you're looking for. So anyway, folks, I hope that was helpful. If you have any questions about real estate, always feel free to leave a comment below. Thank you for watching. And again, if you found value in this, please make sure you subscribe and hit that like button, and I'll see you in the next video.